Imagine signing a promise you know you can't keep. Now imagine millions of people doing it at the same time, and the entire financial system cheering them on. That's not a metaphor. That actually happened. In the early 2000s, banks started handing out home loans to people who clearly couldn't afford them, not by accident, on purpose. These were called subprime loans, and they were sold as a miracle. The terrifying part isn't that people failed to pay. It's that failure was baked into the design, and the system still hasn't learned its lesson. Here's why this matters right now. Every time interest rates rise, every time housing prices wobble, every time debt hits another record, the same structure quietly comes back. Different name, same logic. Subprime isn't history, it's a pattern. So let's strip it down to its bones. No jargon, no textbooks, just the uncomfortable truth. Start with a simple question. How do banks decide who gets a loan? In theory, it's boring. You earn money, you save a little, you borrow an amount you can realistically repay. That's called prime lending. Subprime is what happens when that rule is relaxed or ignored. Subprime borrowers usually had low income, unstable jobs, little savings, or bad credit history. On paper, lending to them was risky. So banks charged higher interest. That part sounds reasonable. But then something strange happened. Banks stopped caring whether borrowers could repay at all, because banks stopped holding the loans. Here's the trick. In the old world, if a bank gave you a mortgage, it stayed on the bank's books for 30 years. If you failed, the bank suffered. That made banks cautious. In the new world, the bank sold your loan almost immediately. To investors, to pension funds, to insurance companies, to people who had no idea who you were. Once the loan was sold, the risk was no longer the bank's problem. So why be careful? This is where the story turns dark. Banks realized something simple and brutal. The more loans they issued, the more money they made. Quality didn't matter, quantity did. So standards collapsed. No income? That's fine. No job? Don't worry. No assets? Sign here. These were real loan types. They even had nicknames. Ninja loans. No income, no job, no assets. That should have been a warning. Instead, it became a business model. But the system needed one more ingredient to survive: belief. Everyone involved needed to believe that housing prices would always go up, because as long as prices rose, the illusion held. So the loans got worse. Teaser rates, low payments at the start, exploding payments later. Borrowers were told, don't worry about the future, you'll refinance. Future you was someone else's problem. And here's the quiet irony. Many borrowers knew the math didn't work. They weren't stupid, they were desperate. Housing had become the only way into the middle class. Rent felt like falling behind. Ownership felt like survival. So they signed. Now zoom out. What happened to all these risky loans? They were bundled together, sliced, repackaged. This is where things stop sounding real. Thousands of mortgages were combined into a single financial product. Then that product was split into layers. Top layers were labeled safe. Bottom layers were labeled risky. Rating agencies stamped the top layers as almost risk-free. The same agencies paid by the banks creating the products. That conflict wasn't hidden. It was just ignored. Investors loved it. High returns, low perceived risk. It looked like free money. But here's the uncomfortable math no one wanted to say out loud. If even a small percentage of borrowers failed at the same time, the entire structure collapsed. Not gradually, all at once. Because these products weren't independent bets, they were tightly linked. When housing prices stalled, refinancing stopped. When refinancing stopped, defaults began. When defaults began, confidence vanished. And confidence was alling that holding it together. The collapse didn't start with Wall Street. It started with kitchen tables. Missed payments, late notices, foreclosures. As houses flooded the market, prices fell faster, which caused more defaults, which caused more foreclosures. A feedback loop. And suddenly, those safe layers weren't safe at all. Banks didn't know what their assets were worth. Investors didn't know who was exposed. Trust evaporated. Credit froze. That's when government stepped in. Not to save borrowers, to save the system. Trillions appeared overnight. The same system that said help was impossible suddenly found infinite money. That contrast still stings. Here's the part that should make you uneasy. After the crash, everyone said the same thing. This can never happen again. And for a while, it didn't. Rules tightened, standards rose. Memories were fresh. But systems have short attention spans. Today, the language is different. The packaging is smarter. The math is hidden deeper. But the incentive structure looks familiar. Loans are still sold, risk is still shifted, debt is still normalized.